invest in active funds or index funds? Which one is better? Do you also have similar doubts? Then don't worry. This debate has been going on for last 50 years. Yes, it all started in 1975 when Vanguard Group introduced the very first index fund. Though investors hesitated initially, over the years, index funds became so popular that today the AUM of index funds is approximately over 2 lakh crores just in India. But with trust came doubts. Which is better, index funds or active funds? Hi, I'm CA Twinkle Jain and welcome to another video about mutual funds. In this video, we will be covering what are active and index funds, their differences, performance analysis and which one should you invest in. Let's get to the basics first. What are actively managed funds and index funds? Actively managed funds are those where the fund manager takes the investment decisions with the objective of outperforming some previously set benchmark index. Index funds, on the other hand, are simply passive funds. The fund manager just follows a benchmark index and tries to replicate the performance of the benchmark index. An index fund or passive fund may simply try to replicate the performance of a benchmark index like Nifty 50. The investments in the portfolio will be in the same stocks that are there in Nifty 50 and in same proportion as they are in Nifty 50. If Nifty 50 goes up by 2%, the fund will also go up by 2%. If Nifty 50 goes down by 2%, the value of the portfolio of the fund will also go down by 2% and so on. If that's clear to you, what are some factors we need to look into before investing in these funds? Obviously, we need better returns, but are returns the only differentiating factor? Not really. Index funds and actively managed funds differ in many other things. Some of them are cost, risk, and flexibility. Let's explore each of these differences in detail. First, the cost. The management fee and expenses of actively managed funds are higher than those of passive funds. In contrast, index funds have a lower expense ratio as it just replicates the index. Expense ratio for index funds ranges from 0.2 to 0.5% annually, whereas for active funds it will be 0.5 to 2.5% annually. It's just 1 to 2%, not big of a difference, right? If you think so, let's look at some numbers. If you invest 1 crore rupees in a passive fund, the annual expenses charged to you will be between 20,000 rupees and 50,000 rupees. If you invest 1 crore rupees in an active fund, the annual expenses charged to you will be between 50,000 and 2,50,000 rupees. The above expenses will be in addition to the management fee that you will pay. The management fee of actively managed funds is also higher than that of passively managed funds. So it's important to look into the expense ratio while investing. Second, risks involved. Both active and index funds have risks. An index fund's performance depends on the underlying index. If the index goes down, so does the fund value. However, active funds may outperform the index because of their active management. At the same time, since these funds rely more on the skills of fund managers, actively managed funds possess a managerial risk. This also takes us to the third factor, which is flexibility of the fund. As we discussed earlier, active fund managers can identify and invest in companies that could grow better than companies that are in the index. So, they have better flexibility than index funds which simply replicate the index that they are following. So, what do you think? Do you think actively managed funds will give you better returns due to their active management? The latest studies show that 53% of active funds underperformed the indices that they were trying to outperform. Index funds have given better returns than actively managed funds in many years in the past. That explains the reason for their growing popularity. Now, which fund should you choose as an investor? If you are desiring lower costs and are content with the returns that a benchmark index is giving, then passive funds may be the right option for you. However, if you are ready to pay higher management fee and the other costs, the desire to outperform a benchmark index, then actively managed funds may be the option for you. But always remember that there is no guarantee that you will get higher returns than a benchmark index just by investing in any active fund. So that's all from my side. I hope this video helps you make smarter decisions every day. Now it is your turn, invest responsibly and make good returns. For more such content, stay tuned to this channel. This is CA Twinkle Jain signing off.
Investment in securities market are subject to market risks. Read all the related documents carefully before investing.